Hello guys. So in this video, we are going to talk about packing credit. So we'll discuss what is a packing credit, what are the types of packing credit, and how it is different from a working capital, which is a common payment tool instrument which is used for to meet up the working capital requirements of a company. So suppose we'll see in this thing, there is an exporter which is based in India, and there is an importer which is based in Germany. So the Indian exporter has to export an order which is of suppose 50 lakh shirts. So for this order, the Indian exporter needs some funds to prepare all the shirts and then to export it to the German country, German client. So for that, there will be some working capital requirements. So at this time, the person which is the Indian entity has two options mainly. One is the working capital, and the second is export packing credit. So export packing credit, we'll discuss about this. So first we'll discuss about the working capital. So now working capital is mainly issued by the banks to the party when there is a short-term requirement of funds. And this is not project specific, or this is not order specific. At the same time, the cost of fund is also high. So around 9 to 10%, maybe it varies for the cost of funds. So now in this case, the Indian exporter goes for packing credit. So packing credit, the exporter approaches its bank and asks for and tells them that I have this order. Will show the all the documents regarding the order, which country it has to be sent. So everything it will the person will share it with the bank. Now, as per the Reserve Bank of India, there are some subventions which are provided for certain category of goods to be exported. So ultimately, that subvention leads to the decrease in the cost of funds for the exporter. So ultimately, from 9 to 10% of what working capital could have uh, given to the client, in this case, it may come down to 5 to 6% or 4% maybe in certain cases. So first of all, the cost of funds will get reduced. So now the exporter will get the funds from the bank to prepare all the things, to purchase of the raw materials, to manufacture the goods, to give for the labor cost and everything. So till the goods are shipped to the German entity, all the expenses will be borne by this type of credit which is given by the bank to the Indian client. So now it is of two types. One is EPC, which is export packing credit. This is in INR. And the second is PCFC, which is packing credit in foreign currency. Now there can be two scenarios. One can be the Indian company asks for the loan in the Indian rupees. Suppose the company XYZ goes to the bank and tells them that I need 50 lakh rupees for my raw material purchase to manufacture and goods. So the bank will give 50 lakh rupees to the on papers, it will be 50 lakh rupees to the Indian company. Now, when the order is dispatched and the foreign party or the importer has given the payment to the client, the Indian company will bond all, and the payment is in euros, suppose. So the Indian company will go to the treasury, will convert the euros to the INR. Whatever the change rate will be, according to that, it will be all the charges will be borne by the Indian company, and 50 lakh rupees will be returned in this case to the Indian bank. But now suppose the company wants the credit in foreign currency only. So now the company goes to the bank and tells them that I need 1 lakh euros for my raw material and all. So amount equivalent to 1 lakh euros will be credited to the Indian party. Suppose it is X amount. So X amount will be credited to the Indian party, but on papers it will be 1 lakh euros. The currency will be euro. Now when the importer will do the payment in euros, the same amount will be repaid back to the bank, and it won't be in the INR. It will be in the euros only. So The person has approached the bank, has asked for the loan in euros, suppose 1 lakh euros. So INR equivalent to 1 lakh euros is credited to the client, Indian client. But on papers, it is showing 1 lakh euros, which has to be repaid back to the bank. So when the importer from Germany gives the payment, at at the same time, the same 1 lakh euros the bank gets from the Indian client that the bank has provided initially. So these are two types of packing credits. One is EPC and one is PCFC. So in PCFC, the currency is the foreign currency involved on papers, and in EPC there is the INR which is given to the client. And as we see that how it is different from working capital, so it is order specific thing. Now suppose there can be a scenario that suppose I have exported one order to Germany, but on time I haven't received my payment back from the importer. Now I have to give back the loan amount to the bank on a particular date. In this case, what will I do? So if it is a running account transaction, then I can repay the bank from some other order which I have exported. Suppose one order I've exported to USA prior to this, and this time I receive payment from that order. So on a running account basis, I can clear this loan, and it won't be a bill specific amount. So this is the thing. And why it is different from working capital? Because it is a low cost of funds. The agreement and the cost is very bearable by the exporter. At the same time, the amount is can be released in phase wise manner. Suppose initially the exporter wants funds only for the purchase of the raw material. So bank, and the amount is 1 lakh euros, and initially for purchase of raw material, suppose 50,000 euros are required. So only 50,000 euros will be given by the bank, and rest 50,000 can be taken by the client whenever the funds will be required. So this is also a very good feature of EPC or PCFC, which you can say. So this is one another instrument which is used in the trade, in the foreign trade, which is very widely used. So thank you for watching this video. Thank you so much.